Welcome back to Debating Your Dollars, where two financial advisors have two opinions with one goal in mind, helping you make the best decisions around your money. And today, we're going to address something that's been very popular in the media in the last few weeks. A lot of clickbait, a lot of headline risk, and I shouldn't say headline risk, a lot of headlines that may be justifiably so.
It feels like it's always in the headlines.
But this time it hit on a level that is exceeding where it has before. And that is using life insurance as an investment in a financial plan. Niko's, again, a newly minted CFP. We're going to get his opinions because there's a lot of folks that will use that CFP designation as an attempt to sell life insurance. And I'm going to tell you, my background, I got into this profession. I cut my teeth with a life insurance company. They were not the go sell life insurance as the solution to everything type company. Had great managers, great bosses, great training that I think has established a foundation for my career. But I can understand I can see where these companies are catching a bad rap. And what I guess to clarify before we get too deep into this is there's a lot of things that will attempt to grab your dollars. And what's happening is using phrases like infinite banking and a permanent tax-free retirement and tax-advantaged wealth management, tax-advantaged solutions, when the attempt becomes to use life insurance as an investment. Now, all that said, I love life insurance.
In certain settings.
I think life insurance is a tool, and it is something that belongs at the foundation of all financial plans.
I think a lot of people would agree with that statement.
But in what kind, whether it's permanent life insurance or term life insurance, for income replacement, people with families, folks with debts that they want to make sure are covered, life insurance has a place in every plan, in my opinion. It's a great way to create a legacy that can change the financial trajectory of a whole lineage. Because it creates an immediate estate. So I want to make that very clear. I am not disparaging the life insurance industry, the life insurance profession, or the need for life insurance. What I think we're both going to question is using it as an investment when it comes to planning a full retirement with using life insurance is flawed. And I don't think that it is. I don't think it's sound. We may get a lot of hate in the comments here, but I don't think that it's a strategy. It's not one that anyone's been able to convince me otherwise yet.
I would agree with that. I think one of the biggest problems with it too is it is a foundational piece to a financial plan. Like, to some extent, you could probably argue that every person needs some sort of life insurance in their plan initially. So I think that immediately kind of drops people's guards down, and they don't exactly listen or understand what they're purchasing, and then they go purchase something that they don't need unless they have $40 million or all these real estate or something along some bizarre, obscure financial situation. They end up buying something. They end up buying a Cadillac when they need a Chevy.
Well, that is a point. There's use to the cash value of life insurance also. And there's a lot of strategies. My brother's in the profession, and he is executing these strategies every day where wealthy business owners need that cash value of life insurance. They can use it to incentivize their employees, especially their key employees. Their strategies that, quite frankly, may be over our heads. And we're going to try to work with my brother to get him onto this discussion because I know there are places where it makes sense.
Yeah, I would say 90% of scenarios is some sort of shorter term policy, smaller term policy, just to complement stuff and get you on your feet and protect you
Right.
when you have, say you're both 30 and just had your first kid. Some of that term solves the issues 90% of the times. Permanent is the other 10.
Mm-hmm.
So that's where you have to figure out what situation as a consumer,
Like a pension max situation.
pension max situation,
Right.
business liquidity, just wholeheartedly want to leave an estate, or if you're ultra high net worth and you're leaving over the $13 million limit in an estate and it's going to get taxed at 40%, you may be able to purchase estate liquidity early or something along the lines of that. But those are really 10% scenarios, right? So like I said, 90% of the time.
We see all the time we see it, folks that come in and say, I bought that life insurance policy as a retirement investment. It's been underfunded.
Yeah.
It doesn't have the cash value. And what do we know? We know that the cost of insurance goes up.
Yep.
And if it's a variable life insurance, which I've never been comfortable with, having my money and my life insurance and the prospects of my death benefit at risk of a lousy market cycle when I am 90 and my cost of insurance is elevated as it's ever been.
Yeah.
And the market, to me, you cannot be disciplined in investing in that type of environment because you may not be able to ride those losses out to where they're helping cover. And all of a sudden you get a letter that says, we need a lot more premium to keep the death benefit that you've had for 40 years.
Yeah. Well, I think the biggest scenario there too is like, say we have a client that comes in, has one pre-existing, didn't buy it from us. And we're either, deciding on keeping it, fixing it, however we're going to do this. We always get the in-force illustration. And I was trying to explain to them when you show max returns to the market is great, but do you need that before you get the nastygram saying this is underfunded, pay us $10,000 or we're lapsing this policy and all that money you spent over the years is gone? It becomes an extremely complex product even for us to work because you almost have to target a percent because you can't afford, you want to, get as much return on the market as you can, but you can't afford the bear markets that we know that are going to happen by surprise.
Right. In a variable life policy, you don't have every investment option available to you.
Yeah.
What are the quality
expenses,
everything? Investment options?
Yeah.
Quality. What's the cost of insurance? Was this cash value structure? And again, admittedly, we don't know a ton about these strategies, but what we do know is that we've seen the failures.
Yeah, you always hear about
the mess. We're hearing about, and by no means do I want to speculate on who was to blame for this Kyle Busch, Kurt Busch, one of the Busch brothers. Kyle Busch mishap.
Yeah.
What we do know is Kyle Busch is a very popular celebrity, a very high-level athlete, tons of endorsement deals.
Yeah.
This is the type of person that has a team of attorneys, and CPAs,
financial
advisors, and this went wrong for him.
Oh, yeah.
Whose fault it was, we'll let the courts determine that. But this went wrong for him.
Yeah.
So if it's going wrong for somebody that has all of the resources in the world to have top minds in all of these disciplines, analyzing this decision
24/7, like realistically,
what is going to happen to the average person that looks at this and says, "Oh, it's infinite banking"? I don't know. I mean, you've been doing this for 3 years. I've been doing this for 23.
Yeah.
The word infinite, when it comes to money,
I can't believe that's legal.
Should never be used. Should never be used.
Yeah.
Because, I mean, nobody has infinite money.
No.
One guy has a whole bunch.
It's a Dr. Seuss adjective. Like,
right.
It's
there's people with a lot of money that to regular folks seems like infinite.
Yeah.
But So, in my humble opinion, you hear that phrase as part of your strategy, get up and go.
Yeah.
Our conference room doesn't lock. I don't know if anybody else's does. None of the doors lock. Get up, play.
Yeah.
That's a phrase that should make anybody
Yeah.
squeamish when they hear the phrase infinite.
And I think you just said it best too. Like Kyle Busch had all the professionals in the world working on this, and without going too far into, like you said, who was at fault there. It's such a complex product,
Right.
that all of these professionals failed to do it. If you get sold this infinite banking strategy, and then they never talk to you again,
Right.
like you're in the same boat as. You may not be in the same
Right,
boat
because
right
the way
now,
most life insurance works, that commission check comes once.
yeah, you're just fingers crossed, praying it works. Like that's what you're essentially doing. This guy had a whole team of professionals, and it still didn't work for him. Doesn't mean yours won't. It's just you have to be so detailed,
Right.
when looking at these things that if you're not able to, you need to get help.
Look at the process that we do with clients that have this.
Yeah,
Not even have the infinite banking mentality,
yeah,
but have these permanent variable life insurance policies that we can't become the custodians of.
yeah.
They've left the scenario where they were invested,
And then,
but this life insurance has to stay behind.
yeah,
And it is hey, listen, every year we are going to help you get an in-force illustration.
that looked like a textbook.
Right. Just so you know, in-force illustration is the guts of the insurance. It will show you the innards of how that policy is working, the cost of insurance. It's the spreadsheet of your insurance policy that shows all the projections and analysis. We want to see that every year
Yeah,
so that we know that, okay, we don't want to get rid of this policy, but we need to make sure that you are not getting a letter in your 90s that says you owe us more.
yeah,
How do we keep this policy afloat? Because now, especially, you've taken maybe their profit center away from them by moving your investment portfolio. They're not that inclined to monitor your life insurance because, listen, that commission check's been cashed.
yeah.
So, again, it's
It's just a sad concept, even. Like, they're spending, I mean, life insurance is never typically cheap. You only know, so you get like a cheap term. A lot of permanent, the words variable, universal, whatever it is typically expensive. They're paying sometimes hundreds of dollars per month. And then now it's 85 and you're getting close to, finally, your heirs are getting close to finally receiving the rewards you paid for your entire life.
and the market drops and now
It is ripped right from under your feet.
Yeah.
And you're like, I just think of all the other things you could have done throughout your lifetime.
Sure.
With $300 a month. Like,
Well, there's a lot of strategies. You hear a popular one is term and invest the difference.
yeah,
I think that's the one that's specifically for young folks, making sure that it's a convertible policy if you have the need to turn it into permanent.
yeah,
But here's the trick. And this isn't magic. You have to invest the difference. And that's what often gets happen is folks, well, I'm just going to get cheap insurance. It's a step in the right direction.
yeah,
But you must invest the difference. Term and invest the difference doesn't work if you just got term.
yeah.
And then haphazard leaders, you have to invest the difference.
Agreed.
And that's where that strategy falls apart because most don't.
Yeah. I think it's interesting too, a lot of people, let's say, that end up buying insurance or very early in their 20s are very in tune and in touch with their finances.
Mm-hmm.
The thing that they forget, even if it's just a cheap term, is at what point do I become self-insured? And at what point can I start to consider, maybe I don't need this at all.
Right.
And we have those conversations.
I've
You gotta walk
accumulated the
through
assets
pros and cons.
that protect that risk.
Yeah, you're self-insured. You don't need this anymore. We should actually take a look at your homeowners just in case, rather than your life insurance policy at this point.
This would be a greater risk there than if you pass away. Yeah.
So I think that's something that like high net worth people don't consider enough is, at some point you're going to self-insure. I think a lot of people, and one of the tricks when they
self-insure
because they have the assets, they have the
assets, but
401k, the brokerage account behind
they don't
it.
have. But Again, depending on what your goals are.
Oh, sure. Absolutely.
Self-insured depends on, all of this is determined on what your goals are.
Yeah.
Listen, I don't think it's anybody's goal to pay more in taxes.
No. Yeah.
Right?
Yeah.
We have had plenty of folks come in, and when we ask them what goals do you have in your financial lives, I don't think one has said, I think I need to be paying more in taxes.
Gonna mail some extra this year.
I'm going to send in a little bit extra for the big guy because I feel compelled to. Never once happened.
No.
So understand, that infinite banking or that permanent tax-free money sounds awesome.
Yeah.
And maybe somebody can join us that can explain how that's perpetually tax-free. That could convince us otherwise. I don't know that I don't know that I could be convinced otherwise.
I'm not.
Maybe that's small-minded of me, but it is. If this is a process that you're in,
Yeah.
get a second opinion.
Yeah. I'm gonna.
Even if it's a second opinion from somebody that shares that philosophy, because most of the time these folks are working for one company that sells one company's life insurance.
Oh, absolutely.
So getting even a second opinion from a second company that sells a second company's life insurance is effective. I'm when I hear the phrase infinite banking, makes my stomach flip upside down.
Well, there's a lot of things that I disagree with when it comes to Abraham. Have you ever heard him talk about this?
I have. I can only imagine.
The clip of him is actually I think it's one of the better things he's ever said and explained. He goes into the tax code basically, and he starts talking about why it's tax free.
A dividend is not taxable because it is not a dividend in the true sense of the word. A dividend is when a company makes a profit, like Home Depot, and they pay their stockholders some of the profit out, and that's a dividend. Okay, life insurance dividends have nothing to do with that at all. There are two kinds of companies in the life insurance world: a stock company and a participating company. Stock company never pays dividends. The only ones that do are participating. The stockholders of a participating company are the policy holders. So if you have a State Farm policy, or you have I don't know, whose is yours with?
Prudential.
Yeah, Prudential's participating, okay? And that means that the policy holders are the owners. Now, in order for them to give you, an owner, profit back, they would have had to charge you extra to create that profit. Does that make sense?
Yes.
So there's no dividend if I own the company and I want to buy something from myself, and I charge myself a little extra so that I can give myself back some more money.
That's nice of you.
That's nice of me. And so that's why the IRS has deemed life insurance policies that have dividends to be non-taxable, because the actual ruling states it's the return of a deliberate overcharge.
Right. Okay.
And that's why it's not taxable. It's a shell game. It's a scam.
In the actual tax
They're
code,
giving you your own money back.
it's a return
I have seen this now that you said
of overcharged premiums. That's why it's tax free. It's not a Roth IRA where your growth is tax free. It's a return of overcharged premiums. So the government is saying, you gave the insurance company too much money, so they can give it back to you tax free. And then they're loaning it back to you for 5 to 7% or whatever the rate is at the time. So you're basically just paying interest on something you paid too much for, which is
he says the same thing. Convince me otherwise.
Yeah,
because while we don't describe to the Dave Ramsey budget hawk mentality, listen, if you follow him, you're not going to be poor.
No.
You're not going to run out of money. You're not going to be wondering.
Yeah.
You may not live the exciting life that you maybe set out for.
Yeah.
But there's a lot of. I mean, his content
thing, he said. Yeah.
His content is financially stable. Again, you may not be enjoying every day.
Yeah.
And
there's definitely
my philosophy has just been that we're putting on this plan to do more than just save, invest, and watch what we're spending.
Yeah.
But the guy's not wrong.
Yeah.
He's exceptionally valued, and you can earn and create and save and change your financial trajectory by listening to him. I don't know what analogy makes sense, but you're getting your own money back
Minus interest.
minus interest. Like,
all right, well, you're going to pay me $10,000 extra this month. I'm going to give it back to you in 5 years, but I'll loan it back.
you're going to loan it back to me, and you're only going to loan me 7. If there's any other topics that you would like to hear us debate, please let us know in the comment section.